Hello. Welcome to the Daily Gold University. Today is lesson number 10. This will be our shortest lesson, and there are no charts and graphs in this lesson. Lesson number 10, Trading and Investing Rules for Junior Resource Stocks. Let's get to it. In this lesson, I will list and analyze some essential rules for trading and investing in individual junior companies and managing a diversified portfolio of junior companies. I developed these rules after trading and investing in the junior sector for nearly 20 years. If I had followed these rules, I would have suffered fewer losses and secured higher profits along the way. Rule number 1. Use a 20% to 25% mental stop loss on each position. If a position drops 20% from its buy price, you should usually sell it. A 20% loss on a position of 5% of your portfolio limits your portfolio risk to 1%. Cutting losses is a vital piece of wisdom that has been passed down for decades from generation to generation. In the junior mining sector, 20% losses can often become 50% losses, which can become 70% losses. Many of these companies do not have significant value to fall back on. You are not buying blue chip stocks. Even companies with good assets can experience 70% losses. There are only two times this rule will hurt you. First is if you buy something too early ahead of a major bottom. The second is if you have a bad entry point during a bull market and buy a stock at its interim peak. Side note, this is exactly where we are right now, so this does apply. One way to prevent this rule from being triggered is to buy in tranches. You could buy a half position. If the stock drops 25%, you could buy the other half. The stock would have to decline over 30% from your original buy price for you to be stopped out of your position. Overall, this rule has a success rate of over 90% in my experience. It works because it keeps losses small and protects against small losses becoming more substantial, which happens frequently in this sector. Number 2, trim your position if it becomes too large or too extended. Knowing when to sell is one of the hardest and most challenging aspects of trading and investing. There is no specific answer, but we have an answer concerning a diversified junior portfolio. If this stock becomes too large as a percentage of your diversified portfolio, then you should sell 1/3 or half of the position. This is trimming. It allows you to lock in some profit and reduce the risk while still partaking in the potential additional upside. Many variables should be considered when judging how much of the position to trim and when to trim. Those variables include the company itself, its fundamental value, how much profit you have, and how much upside potential the company has from that point forward. For example, if a stock has 300% to 400% upside potential after a 150% gain, I would not sell half the position. In that case, I suggest selling 1/3. However, if a stock has risen 200% and has a maximum of an additional 50% to 75% upside potential, I would sell half. This rule is especially important for early-stage exploration companies because they often make sudden vertical moves, and most are not sustained. Some believe that for drill plays, a pre-discovery exploration company, one should sell half the position after it doubles. Ultimately, one must distinguish between speculation, which will be rampant in junior companies during a bull market, and fundamental value. When speculation dominates market moves, traders and investors should be more aggressive about trimming their big winners. Number 3, sell if your reason for buying changes or the fundamentals change. Many things can go wrong or off course in mining and exploration. As a result, as a speculator or investor, you must remain aligned with your initial vision for that investment. When that vision is no longer valid, attainable, or changes, it is a sell signal. Do not justify holding on to your investment by creating a new reason. For example, you invested in a developer because they would build a mine. If they are slow to execute that strategy or postpone construction to do more exploration, that is a reason to move on from the stock. Another example concerns exploration companies. If you invested in one because of its exploration potential, but the company decides to then focus on becoming a producer, that is a course change. Other examples, sell signals, can include economic studies, resource estimates, or drill results that are underwhelming or below expectations. One of my biggest losses in recent years was holding on to the stock of a company that reported a maiden resource several years ago. The grade came in much lower than expected, so I broke this rule by not selling and letting the stock exceed a 20% loss. I broke two rules. When a company fails to meet your expectations, the story has changed, and it is time to sell and redirect that capital into better options. Number 4, overweight and underweight certain positions. A diversified portfolio of quality junior companies can outperform the sector, but do not make the mistake of weighting each company equally. The most significant and largest positions in your portfolio should be the companies you have the most confidence in and generally perform the best. The riskiest positions with the most potential should be underweighted. These include early exploration juniors, drill plays, and companies that have not proven much value yet. The smaller position size limits portfolio risk in absolute terms and liquidity terms. Finally, number 5, buy value and potential based on current future metals prices. The initial temptation is that because gold and silver are in a bull market, one should evaluate and find the companies with the most upside potential at a much higher metals price. However, this could immediately expose you to companies with flaws and therefore more downside risk. Moreover, if you want to bet specifically on higher metals prices, then do so without investing in a marginal company at the same time. Investors and speculators should evaluate companies and their assets at current commodity prices to find underpriced and undervalued stocks. These companies will have significant upside and leverage to higher metals prices. Sometimes that can include a marginal company or two with flaws. These companies may be so cheap and underpriced that they offer significant value at current metals prices despite a flaw or two. That is the end of lesson number 10. Thank you so much for joining me. Next up, in lesson number 11, are my predictions for the new secular bull market in precious metals. Thank you for tuning in.